Good morning and welcome to the Post-Monetary Policy Committee Press Briefing. Today is May the 31st, 2022, and the Monetary Policy Committee of the Central Bank of Kenya held its meeting yesterday, May the 30th. And as is usual, a press release was sent out. And so today, the Governor of the Central Bank of Kenya will take us through a briefing, and afterwards we are able to then set our questions and ask them. As we usually do, we'll ask you to please bring your questions through Slido. That's slido.com. The meeting code is hashtag MPC0522. MPC0522. So without further ado, I'd like to introduce the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge.
Hello, good morning, and welcome to this briefing following the MPC meeting yesterday. Since we last met 2 months ago, the external conjuncture has become even more difficult, not easier. First, from the perspective of COVID-19, it's true there's positive news there that the pandemic is abating, but with scarring in the various in the economy and the people. And of course, we have risk of resurgence. That continues to be a problem going forward. But closer to where the problems are, the war in the Ukraine has worsened and has continued at an elevated pace. And this is obviously a concern, not just for the people of the Ukraine, but also for the rest of the world, as we will explain later. Thirdly, we've had record high oil prices, which have remained, and other commodities as well have hit record levels worldwide in the global markets. At the same time, there is record high inflation in the advanced economies. We already talked about this 2 months ago, but the point is that this has continued, the numbers have continued to rise, as I will explain in a minute. And then against all this is the ravages of climate change and the costs from that, which we need to be aware on a daily basis. So in terms of the presentation, I'll first begin with the global developments. And we've witnessed a dramatic worsening of the global economic outlook. Global growth is now projected much lower at 3.6%, and you can see the slide that is being shown. 3.6% is the most recent WEU projection, that is the IMF. And this is a decline of 0.8 percentage points from the January numbers, and further decline of 1.3 percentage points, from the October WEU. This is dramatic, a change of almost 1% in 3 short months. I think here you can also see the drivers of the decline, or the countries that have reported whose growth has been, let's say, cut or reduced significantly. The United States, I think, is a significant driver in this, also knowing it as one of the engines of global growth. And I think also the other one to note is the euro area at reduction of about 1.1 percentage points. China as well. And most recent news of Q1 in China are obviously quite worrying, because it actually has a significantly a rate that is much lower than what is shown on the board, on the screen. And in sub-Saharan Africa, we can see the numbers there, and the WEU, that is the IMF WEU, actually also scaled down the growth for Kenya by 0.3 of a percentage point. But you can see that for 2022, We are growing much faster than Nigeria, South, actually well above the average of the sub-Saharan region. So this is one of the things that I think we need to appreciate. At the same time, the war in Ukraine has really crushed the recoveries in the advanced economies and exposed the weakness of globalization. And this, for instance, through the imports from Russia, or for most countries, or Russian exports, particularly of oil and gas to Europe. And the prices there have shot up dramatically. And of course, at the same time, you have other imports, wheat, edible oil, fertilizers, which have also been affected dramatically. We'll talk a little more about it at a later point. An important element is the benchmarks of oil prices. These remain high, all of them. And here we are showing the Murban crude oil price. And as of yesterday, it was at $115.8 per barrel. Here we have it at the end of May, it was 27th of May, it was at 114. And again, this is set against where it was before. In April 2020, it was at $20 a barrel. And for 2019, for the year, it averaged around $60 a barrel. And then, of course, in December of 2021, it was at $79 a barrel, and you have the average for January to May at 101.9 US dollars. This has remained a concern, as we will explain later. Another item to talk about in the context of the global developments is inflation in the advanced economies. This is a slide that we discussed last time, 2 months ago, which shows the evolution in those countries, the US, for instance. And you can see the US CPI in April was at 8.3%. This is something that is sort of uncharted territory for them. And 40-year high. UK was in April, was at 9%, which is the highest in the series that they've ever had. Euro area for April was at 7.5%. And again, this is something that clearly has not been seen in that part of the world. Germany, for May, here we have May numbers, it was at 7.9%, which is a 40-year high. So you can already see that these are significantly higher numbers than, say, the 2% that they are used to. And to add to this, in the US, the purchasing power index, the inflation as measured by the purchasing power index, the PPI, was at 11% in April, 11%, which means that there will be upward pressure, or there will be, this will maintain pressure on the CPI. And therefore, it will take some time to bring this down, to bring the CPI, or inflation as measured by the CPI, to more normal levels. Obviously, this is not a time for schadenfreude, but to appreciate the close connection that we all have. We in Kenya are an open economy connected to the others. And no one is an island, to use an overused quote. No one is an island, and everyone is a piece of the continent, a part of the main. Now, in addition to this, there is the specific issues of wheat prices and other commodities, and the slide that you will now see shows you the global developments in key products, key commodities, which have risen sharply. The food index there is the United Nations FAO food index, and the blue is for last year, January to December, so that increased by 23%. And so far, January to May, it has increased by 16.9%. So you can already see that there were problems last year, maybe that were picked up in various ways, but I think the problems have increased, exacerbated in the last 5 months. We've just chosen a few products. Fertilizer, you can see last year 83%, and so far has increased by 7.6%. We talked about Marban oil. Maize, which we obviously are very curious about, you can see that this year so far it has increased by 24%. Edible oils, 36% last year, and so far 28%. And obviously wheat has so far shot up by more than 50%, the price of that. These obviously are in the global markets. And not therefore surprisingly, we would have this would have implications on our inflation. No, let's move away from this slide, please. Let's go back. Yeah, that's okay. So where does this lead us? I think the first point is to underscore that the policy choices for the policymakers are kind of narrow. And I think the first of this is obviously direct intervention through fuel price subsidies. In particular, these have been they have been used in the various economies, the UK, US, Australia, Germany. For instance, the UK last week put in place a 25% windfall tax on profits of oil and gas farms, which is to be used to support or to provide assistance to the vulnerable low-income households, something in the order of the equivalent of $19 billion US. So that is one thing, the direct interventions. Of course, this, as we had said last time, are not permanent. They would need to be temporary, but there is a role for them at this moment. And then, of course, diplomatic pressures on the oil-producing countries and, should we say, also judicious usage of strategic oil or strategic reserves. The strategic oil reserves, for instance, in the US, petroleum reserves in the US, etc. That is important. And, of course, thirdly, monetary policy. So switching from a quantitative easing stance to a sort of a quantitative tightening and other measures, monetary policy tightening, moving from accommodative to a sort of a more restrictive stance, and all those to be done in some sort of consistent way. The bottom line here is that all these are under consideration. The pace of them is obviously important, but also importantly here that there's significant risk for policy missteps. As we know, the financial markets in the last few weeks have been in turmoil precisely because of this sort of inconsistencies in policy pace and also utterances by policymakers. And we do hope that the financial markets settle and begin to provide the right signals all around. So that's what I wanted to say about the global developments. And now we switch to the domestic economy. And the first of this, of course, is inflation. And the slide that we were looking at, you can see where we were in April at 6.5%. That is the CPI index, inflation on the CPI index. And today we are expecting the inflation report for the month of May. We have not yet received it. I presume in the next few hours it will be released. But again, you can see non-food, non-fuel has been low. That's the green. It has been below 3% for an extended period. And what has been pushing up inflation is really food prices, and we talked about this we mentioned this in the communique, in the press release, so I'm not going to dwell on that too much. But I think the point here is that with the rains, we expect that the fast-growing commodities, crops, sukuma wiki, vegetables, and perhaps even tomatoes and other things like potatoes, etc. This will come to the market quickly, and therefore will exert a sort of a downward pressure on prices and on inflation. So that is what generally happens. But then you also have the fuel inflation, or the fuel price, and that is the red, and you can see that has accelerated to 8.5%. The point here is that this embeds, or the government measures, the measures that the government has taken to moderate domestic prices are embedded in those prices, are embedded in these outcomes for particularly the one on fuel, the price of fuel, the subsidies that are being provided for that. And there are other measures that have also been put in place, for instance, the waiver of import duty on maize, and also the waiver, or rather the subsidies on fertilizer prices. So we do expect that those will remain, at least in the foreseeable future. But even against that backdrop, the MPC assessed that there's a clear and present danger of breaching the 7.5% threshold in the next few months. And also understanding that those policy measures that the government are taking are favorable and will remain in place, at least in the foreseeable future. And it is in that context that they decided to increase the CBR, and that is our signal rate, as you know, from 7% to 7.5%. And in a sense, this not only provides some sort of aggregate demand management, sort of trying in the near term bringing back demand, but also sends a strong signal about our stand on inflation, meaning that we will take all measures necessary to deal with inflation. Now, it is clear that supply side driven inflation, let's say the cost push, there's virtually nothing that monetary policy can do to deal with that. But what monetary policy does is to deal with the so-called second round effects, meaning when those prices go through to the other commodities that the products are inputs for. So that is really where monetary policy begins to operate. But even then, of course, we do understand that it isn't totally effective. So I think the point there is to underscore the government measures, and to also underscore that the clear signal about inflation, or the stance against inflation, and indeed that will need some time also, about 3 months to work through, according to our estimates, I think it is 3 months, to work through the system from when the measures are put in place to actually when they are completely embedded in the economy. So that's what I wanted to say about inflation. Now we can move to the second. Oh, actually there's some other charts that we may want to see. This shows the sort of 12-month growth rate, or 12-month change in the prices of key food items. And so you can see the green is maize flour, and cooking oil, you can see, is the gray, and indeed sukuma wiki is the blue. So I think you can see that this indicates the sort of signals that we are getting from the consumers in terms of prices. And then on energy items, it's on the right-hand side. So from electricity, which showed us a decline of 0.2%. And again, I think with time, this number will be examined a little more. And yeah, whatever it is. Again, agriculture, we've made the point before that the statistics for agriculture probably need to be strengthened in terms of collecting them, etc. But anyway, as of now, these are the numbers that are put out. And the ones I would mention, we've used these new numbers. I'm talking of the 2021 outcome, and also the new WIO numbers, and these are the April WIO numbers that show the potential, or should we say the outlook for the global outlook for 2022, etc. And we've used this to make the projections that are shown there for 2022. So this is, in some sense, a more robust estimate of our projections for 2022. I think the bottom line there is we are showing a growth of 5.7%. And even then, we would say that these are numbers that will change. We'll need to do another more detailed check of them for the reasons that I mentioned. Some of the numbers need to be confirmed. But I think also the outcomes in, the sort of leading indicators that we have used will need to be strengthened in particular ways. I think the first quarter of 2022 is showing strong, I mean, the strengthening of the economy has continued in Q1 of 2022, which we have projected a growth rate of 7.1. Now, the only thing I wanted to say about 2021 versus 2022 is the strengthening that has taken place in some of the key sectors. I think first and foremost in general services. Services have strengthened and continue to remain strong at 6.5. But I think pulling it, looking at it in detail, accommodation, that has rebounded quite strongly, and we'll talk a bit more about that later. I think the other one to mention is ICT, information and communication, at 9%, almost 8.8, and then for 2022 at 7.9. Education, which had declined significantly, has rebounded, and obviously we know that will remain sort of a steady growth in terms of numbers of students, et cetera, et cetera. And the one to mention is, I think, agriculture, manufacturing at 7%, and indeed annual projection of 3.4. I think given the possibilities, this still is a low performance. Really, manufacturing needs to do better than this. Mining and quarrying is growing strongly at 18%, it was 18% and will continue at 8% going forward. So I think the economy, again, is expected to remain strong, despite all the concerns that people may have, and I'll come to that in a minute. The next slide shows you, I know I said that we'll probably not be showing this slide all the time, but anyway, for now, let's show it. It shows the real GDP per quarter versus the composite CBK composite index. So the composite index is the blue. So that's our projection given all the information, detailed information that we get. And the green is the outcome. So you can see the blue tracks the green very well. And in particular, as I said last time, the turning points. The turning points, we hit the turning points, except in 2020 Q4. The numbers were very much aligned. And I think this is why we are saying that 2022 Q1, we expect it to be growing strongly. Now, don't ask me why we have 7.2 there and 7.1 in Q1, but I think those are the sort of details of rounding that continue to bedevil, let's say, analysts. So let's move on. I want to go through quickly some of the key sectors. Again, this time I don't want to belabor on the numbers, but the details are there. So first and foremost, transport and storage, and you can see the black on the left-hand side. You can see the growth rates are quite high, so 20% level year on year. And I think we can understand why, particularly as as the economy has reopened and transportation of goods, including even across to neighboring countries, that has kind of come back again. So I think that is important. Of course, we also have the turnover on accommodation and food and services. This is the turnovers in the, let's say, the hotels, etc. And you can see that is growing quite strongly. We'll talk again about the hotels in just a minute. Manufacturing sector. Growing again quite strongly at 20%. And this is the turnover again, and the turnover on wholesale and retail growing also quite strongly, 12%. I think this also is driven by other factors, as we know, like education, the reopening of schools, etc. But I guess the point here is that all these are showing significant growth. Cement consumption, again, this continues to grow quite strongly. Nothing really to mention here except that it points to a significant growth in the building and building sector, etc. Cane deliveries. This is an interesting slide, particularly knowing where this industry has been and the recovery that is taking place. So now you can see the growth rate. In March, it was at 16.3. And I think we do hope that this will continue. This obviously relates to production of sugar as well. So there is that agro-processing and indeed on the manufacturing side. Power consumption, another slide that shows that strong positive trends. And I think this is both on the small and indeed large power consumers. These have continued to grow quite well. Then credit. Credit on 12-month credit. And I want to show the 4 large quote-unquote sectors. You can see transport and communication. That is growing quite sharply. The year-on-year growth is above 20%, or has been above 20% since January. And on trade also, that has been around 10%. And manufacturing, slightly lower, but also strong. And finally, consumer durables. This is significant. It shows also, in some sense, you could think of it as a proxy for consumer confidence. How confident are consumers? This and other consumption of, let's say, hotel and accommodation, etc. Those sort of services. So, on the whole, I think the only other point to make here is that on the whole, we see a continuation of the robust growth that we saw in 2021 and the first quarter of 2020. Now, I want to say just a few things about the banking sector. First, of course, is the 12-month growth in private sector credit. And I think we have the slide that is the slide that we are looking at. And you can see for April, we are at 11.5%. And you can see that since July of 2021, there has been a steady sort of increase in that growth rate. And I think some of you last time had been asking me how, whether we'll get into the 10% range, and we are already there, both in March and also in April. So that is something that we need to appreciate. However, I think it is important to note that as was confirmed in one of the most recent credit officers' survey, which was carried out at the end March, that is now public. It has been circulated. It's put on our website. The credit risk appetite among the banks is expected to remain constant, right? And so the credit standards also will remain tight. And so we are not expecting this growth to be based on, let's say, lowering of credit standards. On the contrary, the standards will remain tight. And therefore, this is a reflection of strengthening of the economy itself, meaning there are more, let's say, projects that, projects that banks are willing, under the same standards, to invest in. On the credit side, I think rather on the banking sector side, the sector remains stable and resilient. There is sufficient capital and liquidity buffers, and I think liquidity is also adequate and well distributed across the sector, and there has been less use of reverse repos, etc. The only other thing to mention here is that the NPLs to gross loans, they stood at 14.1% at the end of April, and this is marginally higher than 14% in February. And as we noted before, this were the NPLs, rather that led to this marginal increase, were noted in manufacturing, trade, building and construction, transport and communication sectors. And it is again clear that some of these are large, let's say, credits. So we can really identify the credit and that where it is. It's not sort of generalized increase across the board. That's what I'll say about the banking sector. I want to say a few things about the CEO survey, which I think this time around was quite interesting. And I mean, I think these surveys, the three surveys we do, in my view, they are really exciting. They're really interesting. And the first of this is the CEO survey. This is one slide from it. I presume we'll put out the entire survey in its entirety in the next few days. But I think here it's interesting what was revealed by the CEOs. First, on their optimism, and they were quite optimistic. You can see in May they are at 3/4 of them are optimistic in terms of, they expect higher business confidence or business confidence to remain the same. Only 24% indicate that it will be lower. That is, their business confidence will weaken in the next 12 months. And that is for the companies and the sectors. When they are talking about their own sector, their responses, they are just pretty much mirror their responses with regard to their own company. Then you have the TD. Another item that was important from their perspective is the recovery. Obviously, I'm sorry, I've lost my train here, my train of thought. So I was going again as to the things that have come through the CEO survey. And it was interesting to note the sectors that they pointed out: agriculture and services sector, right? And obviously pointing to the improved COVID situation and the easing of travel restrictions, etc. And they were generally positive in various sectors, all these services and agriculture, etc. Now, what were their concerns? The concerns were mainly the rising inflation, and that they identified, and again, persistent global supply chain disruptions, which we have noted before, and the increased political activity in the context of the elections that we are going to have in the next 3 months, in August. And of course, the continuation of the conflict of the war in the Ukraine, and the impact of that on commodity prices. On the MPC Market Perception Survey, again, the responses match or mirror the responses in the CEO survey. And I don't want to go through it again, but you can still see significant optimism in terms of the 85% of bank respondents were optimistic, and on the prospects of the economy over the next 12 months. And indeed, on the non-banks, that has pretty much remained flat since our March survey. The hotel sector, the hotel survey, this was actually possibly one of the most interesting, let's say, responses that we got. So let's begin from COVID, right? When COVID hit, it hit in March. So you have February February of 2020 as a benchmark. Let's see on the left-hand side, and you can see the black is Mombasa, and you can see Mombasa, at least has actually matched or achieved the levels that were above the levels in the pre-COVID levels in terms of bed occupancy. And you can see also the Nairobi hotels, they are coming along, and indeed also the hotels in the rest of the economy or the rest of the country. So in some sense, this is a very positive sort of outcome that we are seeing, because as you know, this sector has been lagging quite a lot. It's been hit twice, first COVID, and then secondly the war in Ukraine, and so in some sense a recovery seems to be well underway. Now, the next slide indicates the conference service, the conferences or services for conferences. And these are important, particularly in Mombasa, but also the rest of the country. And you can see the numbers are climbing, and in some sense we are pretty much in a good trajectory. The next one is about forward booking. This is quite interesting. So forward booking for May and June. Remember, we asked them. This survey was conducted in the first half of May. So that's why May is still a projection. And you can see June and July, Mombasa is at around 50%, Nairobi 36% and 20%, 18%, and the rest of the economy around 15%. These are good numbers if you're thinking forward booking, let's say 1 or 2 months, particularly as we all know that some of us are very slow in booking. So we are last minute sort of believers of the last minute, which obviously does not support good planning, but there it is. So that's what I wanted to say about the surveys, and they'll be posted in the next few days. And again, I encourage you to look at them. They'll be on our website, and they are very interesting. Other things that I didn't mention that are in there, that you will find in there. Now I move to the external sector, and this is more the balance of payments. The first of this is on exports, and this is the 12-month to April exports. And you can see tea exports have grown. Horticulture has fallen. This is, we understand that there were some problems in the exports of avocados. And this is what, in some sense, gave rise to this decline from 1,068 to 1,044 instead of the growth that we were expecting. But that problem has now since been resolved, and we understand that the exports are finding their way to the markets, etc. There is manufacturing again, which, as I see, could have been a lot stronger, coming in at 454. In the context of having more direct, the neighboring countries, for instance, are now receiving our products. Also for that, so in some sense, the exports here need to be energized. The exchange rate also should be supportive of exports. So from that perspective, I think it's a bit disappointing to have manufactured goods just at 454, growing marginally from 421 last year, over the same period last year. Then in terms of exports of tea, I think this is an important slide, largely because we do have some exports to Russia and the Ukraine, which is sort of on the right-hand side. But you can see they are not as significant as the increases that we have had to Pakistan and Egypt. So those two increases dominate the exports to Russia and Ukraine. And so, yes, this has continued to improve the demand on that. And again, the prices may change for different reasons, but I think on the whole, that has been strong. Imports of goods, I think the one to note here is oil. Again, this is the 12-month to April. And the 12-month to April 2021, our imports of oil was 2.238 billion, and now we are talking 4.157 billion. So that is significant, and we talked about why that is the case. And you can see the others as well, machinery and transport, etc. All these indicate significant or point to significant dynamism in the economy. Imports of, again, this one is done by broad category. So you have consumer goods. You can see that is growing quite strongly. And again, this points to the consumer confidence. Capital goods, there has been a lot of need for that. And indeed, the intermediate goods, which have grown quite sharply from 9.7 to 12.5 billion for the 12 months to April 22. That includes oil, but when you remove oil, you have the one on the left-hand side, on the right-hand side, and that is also grown quite well. Now, other things that we need to point out is services, strong services of exports. And the travel receipts, I think you have the dark green. You can see that is growing quite well. And the transport receipts also are significant for us. And this is important because, as well, we expect this also to grow quite well as we support the exports to the neighboring countries. And you can see that has not disappointed. The green, the dark green bars indicate how far this has grown. Tourists' arrival. this has continued to improve. I don't want to talk too much about it, but I think you can see the greens on the left-hand side. And clearly, we are still way off the pre-pandemic levels. But a journey of 1,000 miles begins with a single step. And I think the direction is clear. So this is something that obviously we expect will accelerate as the tourists begin to take their vacation. We are going, very soon we'll be in the season of the migration, the wildebeest migration, which obviously is a peak for various hotels in the Mara and other places, and even in Nairobi, as the tourists come in and sort of transfer to those hotels. So I think the point here is that this is something that we expect to continue. Diaspora remittances have remained strong. I think we've given you the monthly numbers, which are already on our website. But for 2022, the 12 months to April, you have almost 4 billion. And this is way above the 3.3 billion that we saw in the 12 months to 2021. So, bottom line, the current account deficit, and we are projecting now, so far it is, we have, well, for the year 2021, this is revised at 5.5%, and the year to date, to April, is 5.1%, the deficit. And we expect this to grow to end at the end of 2022 at 5.9. Obviously, a lot of that is driven, that increase is driven by the oil imports, which I showed you earlier, are significantly higher than where they were before. Moving along then, what about the rest of, what else can we say about the balance of payments? We've talked about the exports, we've talked about the imports, we've talked overall about the current account, but what about the market, the FX market? I think the first slide there shows the evolution to date. This is to May 2025, of the various currencies. I think we can all understand why the Russian ruble is an exception. But that is not for this discussion, but one can understand why it is an exception. And why, and what we have here is most currencies have depreciated against the dollar. And you can see the US dollar index there. That is an index of the US dollar against most major currencies, the dominant currencies. So the US dollar has appreciated by 6.8%. And other currencies, I think you can see the euro has depreciated at 6%. And the other one that maybe the Swiss franc, 5.2. But I think the British pound at 7.4. So coming closer home to the African currencies, or the currencies in Africa, we are still against the dollar at 3.14, 3.1. And you can see we are pretty much in the middle of the pack. I think it is important to note that what has actually been happening in the currency markets. And why is it that the US dollar has strengthened so much? And it is because of their stance on the quantitative tightening that they have been doing. And really those policies have attracted inflows back into the US from all the other countries, and really strengthened their currency as opposed to other currencies, therefore, that have weakened. So in a sense, it's a play in the advanced economies and a play on the dollar, as it were. And I think this is why we feel quite confident about the reasons for our depreciation by 3%, and also about how much it is, level of the depreciation of 3%. And I think this is something that maybe some, well, not so much requires more explanation, but requires just appreciation of what underpins it. On the financial markets, I think but before going, yeah, maybe you could discuss this now, but we have repeated the currencies, the US dollar chart there, but I think also to show you the evolution of the usable foreign exchange reserves on the right-hand side. So we are around 5 months of import cover, and I think it was reported in terms of precisely where we were in the communique. I think it is important to underscore our policy on the foreign exchange market. This is something we've underscored again and again, that we have a flexible exchange rate regime, and we do not target a rate, we do not target a direction. We allow the exchange rate to move based on the supply and demands in the market. What we do is to intervene when there is volatility, so to stem volatility, to reduce any volatility that may be emerging in the market. And that's our policy. It has served us well all these many years, and we will continue to pursue that policy. There was finally that last part there on government borrowing, and I think it is important to show you, for those of you that are looking at our stocks, bonds, etc., well, bills and bonds. Our domestic target for this year is actually 664, maybe 662 billion Kenya shillings. That's our domestic borrowing target. And so far, you can see how we are tracking towards that number. And as you know, there's already an IFB, which is the infrastructure bond that is out. And there'll be other things, the T-bills for the rest of the month of June, etc., that will help us close that gap and, in a sense, achieve our domestic borrowing target. The yield curve is shown there. That's really the green, and you can see it is well behaved and has moved gently. And we are confident. This has actually been one of the achievements that we have had over the last few years, establishing this yield curve, well behaved and stable. Colleagues, those are the things that I had. I think there's a lot of material that we are going to put out, but I think on the whole, the MPC decision was based on the realization or the appreciation of the clear and present danger that was there. And indeed, we'll continue to observe the developments in the market and to take whatever measures are necessary to maintain stability and indeed to support the rest of the economy and all economic actors. Thank you very much. I'm now ready for your questions.
Thank you. That was the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge. And so now we go straight to the questions. And a reminder, if you still intend to send your questions, slido.com, slido.com. The meeting is hashtag MPC0522. We start with John Otini of MediaMax. John says, the Kenya Association of Manufacturers and Oil Importers say they are struggling to obtain sufficient dollars in a timely manner from banks. What is CBK's position? He continues to say, KM say they're buying a dollar at 120 shillings. Why is there such a large difference from the 116 shillings quoted on the CBK website? Eric Mbok of Bloomberg is a similar question. KM warned of a risk of parallel FX market in Kenya because of the dollar shortage. Are you concerned about this? Where are KM members accessing dollars? Felix Ochieng from the trading room, again, similar question. What is CBK stand on the dollar shortage and alleged parallel forex stations as said by importers, my apologies. And lastly, Herald Olo from the People Daily. This is in September 2021, the dollar stock stood at 9.5 million compared to the current 8.1. Is CBK worried about this gradual decline, and what is it doing to prevent further dips?
Okay, thank you. I want to begin with the last question, Harold Allo, about the levels. And I think this is clear. We have sufficient, let's say, reserves. There is a reason to have reserves, to hold reserves. And I'm not going to go into the discussion now. But we are using our reserves for payments, for debt. We are using reserves for payments of, let's say, services that are needed, or for that matter, various components, medicine, etc., that the government imports. So we are not worried about that. We do project these things way in advance. So we have a projection running 2 years from now, and actually can go even further if we wanted to. But in a sense, for robust planning, we have at least a 2-year horizon, and we are quite comfortable about the levels that that we will have on a monthly basis, on a weekly basis, and even on a daily basis. So I don't think there's any concern. We give you the number in terms of precisely where we are. And just to quote this, we are at 8.2 million, which is 4.9 months of import cover, well above our 4 months import cover that we generally we have a recommendation for in the context of EAC. But actually, in most economies, if there isn't any other agreement like the EAC, 3-month import cover is sort of like the bottom, the threshold that you should not get to. So I think we have no concerns at all in terms of the level of. In terms of the other questions, the John Otini, Eric Mbok, and Felix Ochieng, you're asking about the Kenya Association of Manufacturers and a story that has appeared in the pink paper. So I would encourage you to talk to the Kenya Association of Manufacturers. They're the ones that are creating the story. So you ask them. You ask them. You ask them what is all this about. It's interesting that some of the people that are writing to us don't even have positions. They are not in the market. They are traders. Yeah. But I think the point is that you talk to whoever has a story. The pink paper seems to also run with the story. So ask them. Ask them. In terms of where we are, I think I've explained this. There's a market. The market covers a lot. The market generates and distributes something like $2 billion US every month. So if you have somebody who is importing, let's say a sector that is importing 90 or 100 million, I think that is nowhere near the 2 billion that we are putting out there. And they should understand that they're small in that sense and sort of go to the market like everyone else. All those other 2 billion, they're working in the market. So there are no favorites. There are no favorites in the market. Follow the rules of the market and everything will be okay. So I think I encourage you, if you have those questions, you go ask them. They seem to be the ones that are generating the questions. Any other question?
The second round of questions will begin with Kefa Moirori from Radio Citizen. And Kefa asks, what is the expected impact of high inflation on CBK's 2022 growth projection? And what are the ramifications of high interest rates on the country's macros? Jimmy Mbogo from the Business Hour, financial stability conditions in the euro area have worsened with the Russian invasion of Ukraine. What impact will this have on the Kenyan economy ultimately? Ramanyang from CGTN asks, what data informs the governor's view that manufacturing should do better given the tax uncertainty, foreign exchange access, input price hikes that the sector is facing?
Okay, fine. So the first question, Kefa's question about expected impact of high inflation. I think the point here is that we don't expect, you see, if we allowed inflation to just get into the economy, right? Then, in some sense, it would be significant. It would be damaging significantly, right? So my point here is that we don't want to go there, and that's why the MPC took that decision, and will maintain a watchful eye on developments. That's also why the government has taken those decisions to intervene in those ways. We talked about the fuel price, etc. So in some sense, it is to guard ourselves against those bad scenarios that may take place. So my point here is that let's not worry about the what-ifs of significant, let's say, macro imbalances that may take place. That is precisely what we are trying to avoid. Inflation to growth, etc. Really, all those things, the channels are clear, right? But I think the most important one that I would put out there is consumer confidence, and indeed also confidence of investors. It shows that really the macro is the macroeconomics or the macroeconomy is sort of out of work, you know, meaning weak. And that gives them pause, that gives them concerns, and really they want to wait and see. So there are other channels, but I think those ones are significant if you are thinking of how this would happen. Now you're talking of higher interest rates. This really was only 50 basis points. So the point here is that yes, this will have an effect of constraining aggregate demand, and also indicate the direction. In a sense, is a very strong signal as to where the central bank wants the economy to go. Now, Jimmy asked about the financial stability conditions in the euro area and the impact on Kenya. Okay, so I think the financial stability conditions, we are more concerned about the U.S. rather than the euro area. I mean, let's be clear. The biggest markets here are actually in the United States. And the turmoil that I talked about was largely in those markets, and all other markets sort of take their cue from those large markets. That's the U.S. T market, and that's the cash market there, the T-bonds and etc., and T-bill, and then you generally liquidity, and then you have other things, the securities exchange, etc. And all of them are connected. All those large markets are connected, but I think they take their cue from the economies, rather the markets, the large markets in the U.S. So I think the point here is that, as I said before, our connection with Ukraine is limited. Our connection with Europe is strong. Our connection with the U.S. is strong. But I think I already explained how that would play out in time. And then Raman asks me what data informs the governor's view should do better. Well, maybe I should ask the question. What data tells you that it shouldn't do well? Maybe you should answer that question, Raman. And like everything else, Raman, we all have problems, right? We all have problems. And I think the issue for me is to appreciate that every single sector has its problems. If you sat down with a farmer, they'll give you all their problems, from rain, fertilizer, seeds, everything, a long list. If you sat down with a student, they'll also give you a long list of questions, of issues. If you sat down with a central bank governor, he'll also give you his long list of issues. So I think there's a danger here to think manufacturing is kind of special. And that's what I'm trying to explain to you, that actually it's not. So sure, there are all these issues of tax uncertainty. Sure. There are issues of input prices. But I don't think they are any different from any other person. If you ask or any other sector, if you ask the farmer, they'll tell you, my input prices are changing, and I have no control of that. So I think the point here is to appreciate that we all have to do our job. Let's do our job, and then, without complaining, let's do our job.
The next set of questions, we begin again with Rama from CGTN Ramanyang. He asks, could the governor provide any forward guidance on rate hikes in the second half of 2022, assuming internal and external inflation drivers remain the same? Kefa Moirori, Radio Citizen, what is the CBK's outlook on non-performing loans going to the end of 2022, noting that the impairments have tied the COVID-19 peak of 14.1%? Is there any other reason for the jump in non-performing loans? Finally, Rama again, per CBK and KNBS data, export revenue is rising, remittances are hitting record levels. So what explains the current dysfunction in the interbank USD market?
Okay, so maybe the first two questions. Raman is really working overtime here, I see. I think there's enough forward guidance in what the MPC did by raising the CBR by 50 basis points. So that is sufficient forward guidance. Also indicates that we stand ready to do what it takes to deal with what is necessary to deal with any potential, let's say, increases in inflation or financial stability, etc. So I think that is sufficient, clearly communicated, and we watch and see how that works its way through the system. I'm not sure about Kefa's question, asking about NPLs. So 14.1 from 14, I can hardly classify that as a jump. Actually, one could even say it is in the rounding, right? So the rounding of the number at the end. So I don't think the issue here is to worry about why it went from 4.0 to 14.0 to 14.1%. And I think I explained, that's why I quickly talked about the credit officer survey. It would be of concern if the standards were lowered, and lending standards. And this is why I mentioned that according to that survey, which is, you can see it on our website, and you can see other data there, the survey indicates that the standards will remain stringent. So the only, let's say, explanation for increase that I talked about in new lending, the 11.5% growth in private sector credit, etc., is that the economy is strengthening, and there are more opportunities for investors, manufacturers, farmers, every one of us, people that are building properties, etc. So I think it is more that, and we should expect that to happen. That is the mark of a well-functioning economy. Raman then asked about the data, and then, so what explains the current dysfunction in the interbank market? I think, Raman, the Kazi Kwako, you explained this dysfunction. You're the one that's pushing it out there. So please ask the people that seem to claim that there's a dysfunction in the market. It is important to understand that the market is not, I just told you, is at 2 billion per month. That's significant. So if you have an actor who is coming in looking for 1 million or 10 million or even 100 million, and claims that it is dysfunctional, I think kazi kwako. What is clear is that a few months ago, 2 months ago I think it was, there was significant demand, unusual demand, mainly because of the dividends that were being paid out. That I think we all understood. But that whole season has ended, right? The dividend season. And the money has been transferred, etc. And of course, there has also been other pressures from increase in price of oil or increase of other products, the price of other products. And that is coming through. But the point is that that can very well be taken care of in the market if you go to the market and deal with the specific banks according to the rules of the market. And that means the banks, yourselves, and indeed the dealers are aligned about how the markets operate. And for you as a customer, you don't need to know all the rules. Just go to your bank and present your information, what you're making payments for, etc. So as for the dysfunctionality, it is you to define it.
Just looking, there are no more questions that I can see. There's just a variation on the theme. And so that brings us to the end of today's press conference. This, just a reminder, is a press conference held after the Monetary Policy Committee meeting that was held yesterday. And so we expect another similar one after the next Monetary Policy Committee meeting. But for now, we thank you very much for taking your time to join us, and we shall see you then. Good afternoon.